Hello fellow compounders, welcome back. Today we're talking about a strategy that's simple, powerful, and proven. The core satellite portfolio. Whether you're just starting out or refining your approach, this framework is designed to balance stability with growth while keeping your risk under control. But first, have you joined or always been compounding online community yet? It's where smart investors like you connect, share ideas, and get inspired to build wealth. It offers both free and paid options, so you can choose the level of access that works best for you. Whether you stick with the free areas or explore the premium resources, it's a supportive space packed with value. Check the link in the description and join us after this video. Now, for those who are new here, I'm Dennis Chen. I'm a former hedge fund manager and management consultant, and I hold an MBA from the Wharton School. My passion is helping people simplify complex investment concepts to achieve financial independence. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you're responsible for your own financial decisions. Section 1. What is a core satellite portfolio? All right, let's break this down. A core satellite portfolio is all about combining a stable foundation with dynamic opportunities. The core makes up the bulk of your portfolio, typically 70 to 90%. It consists of broad, low-cost index funds or ETFs that gives you steady, reliable market exposure. Think of it as the solid backbone of your investments. The satellites, on the other hand, are the exciting part. These are smaller, more focused investments, individual stocks, sector ETFs, or even alternative assets. They allow you to take strategic bets without putting the entire portfolio at risk. Together, those two components create a winning combination of stability and growth. Imagine this. Your core is like the engine of a dependable family car. It keeps everything running smoothly. Your satellites, they're the turbocharger, adding extra speed and thrill to your ride. The engine ensures reliability while the turbochargers make things exciting. Section 2. Why choose this strategy? So why does this strategy work so well? Let me highlight 3 big reasons. Number 1, diversification. Your core gives you broad exposure to the market, spreading out your risk across hundreds or even thousands of investments. 2, flexibility. Satellites let you personalize your portfolio, aligning it with your goals, interests, and market insights. And 3, cost effectiveness. By keeping most of your portfolio in low-cost index funds, you save on fees, which can add up to thousands of dollars over the years. In a nutshell, this strategy gives you the best of both worlds. You're anchored with stability while having the freedom to chase growth opportunities. Think of it like building a house. The core is the solid foundation, ensuring stability through storms, while the satellites are the custom features like a sleek modern kitchen or a game room that make the house uniquely yours. Section 3. Building the core. Let's start with the foundation of your portfolio, the core. My recommendation, the Bogleheads 3-Fund Portfolio. But what is it and why does it work so well? The Bogleheads 3-Fund Portfolio is named after the followers of John Bogle, the founder of Vanguard and a pioneer of low-cost investing. This strategy embraces simplicity and efficiency, offering exposure to 3 major asset classes through just 3 funds. The idea is to achieve maximum diversification and long-term growth while keeping cost and complexity at a minimum. Here's why it's a game changer. Number 1. Low fees. By using index funds, you're avoiding the high costs associated with actively managed funds. Over decades, this can mean saving tens of thousands of dollars. Number 2, broad diversification. You're essentially investing in the global economy, spreading your risk across thousands of companies and bonds worldwide. 3, ease of management. It's straightforward. You don't need a finance degree to set it up or maintain it. This is why it's perfect for both beginners and experienced investors alike. Here's how you build it. The first fund is the US Market Index Fund. Capture the growth of the American economy with ETFs such as the Vanguard Total Stock Market ETF, ticker VTI, Schwab's US Broad Market ETF, ticker SCHB, or iShares Core S&P Total US Stock Market ETF, ticker ITOT. Fund number 2 is the International Market Index Fund. Ensure global diversification with Vanguard's Total International Stock ETF, ticker VXUS, or the iShares Core MSCI Total International Market ETF, ticker IXUS. And fund number 3 is the Bond Market Index Fund. Add stability and reduce volatility with the Vanguard Total Bond Market ETF, ticker BND, or iShares Core US Aggregate Bond ETF, ticker AGG. This simple approach keeps costs low. For example, the expense ratios of these funds range between 0.03%, 3 basis points, to 0.08%, 8 basis points, giving you a portfolio blended rate between 0.04% and 0.06%. This means that for every $10,000 you invest, your annual cost is as low as $4 to $6. It doesn't get much more efficient than that. Picture this, with just 3 funds, you're essentially owning slices of tens of thousands of companies and bonds across the globe, like having a front row seat to the world economy. This isn't just an investment strategy, it's a ticket to participate in the success of global markets. Section 4, choosing satellites. Now, let's spice things up with the satellites. These investments should make up 10 to 30% of your portfolio and give you the chance to pursue higher returns. Here's what you can include: individual stocks, which are companies you believe in, like innovative tech firms or emerging leaders in the renewable energy; thematic ETFs, focused funds that track trends in AI, clean energy, or healthcare innovation; and alternative assets. Want to explore real estate or even crypto? Satellites let you experiment without derailing your overall plan. Satellites are like your playground. They let you express your unique vision and take advantage of timely opportunities. For instance, if you believe in the future of electric vehicles, a satellite investments in Tesla or BYD could be your way of riding that trend. It's like having VIP access to the most exciting sectors of the market. Section 5, example portfolio. Building a $100,000 core satellite portfolio. Here's a practical example. Let's say you have $100,000 to invest. Here's how you could allocate it. Your core portfolio is 80% or $80,000. We'll put $40,000 in the US stock market ETF by Vanguard, ticker VTI, $20,000 in the international stock market ETF by Vanguard, ticker VXUS, and $20,000 in the bond market ETF by Vanguard, ticker VND. On the satellite side, we're allocating 20%, which is $20,000, and we'll use the basketball team approach. So at the position of point guard, which is the growth leader, we'll put NVIDIA, NVDA, that's the ticker, for $4,000. At shooting guard, which is the scorer position, we'll use Apple, ticker APPL, for $2,000. At small forward, it's an all-rounder, we'll use Alphabet, which is GOOGL, Google, at $3,000. At power forward, is the defensive player, we'll use Johnson & Johnson, ticker J&J, with $2,000 allocation. And at the center, which is our strong foundation, we'll add my favorite stock, Berkshire Hathaway, ticker BRKB, and we'll add $3,000 to that. Of course, we'll have bench players, which are the specialists. We'll have Microsoft, MSFT at $2,000, Realty Income, ticker O, with $1,500, Danaher Corporation, ticker DHR, with $1,500, and my favorite Latin American airline, Copa Holdings, ticker CPA, with $1,000. This balanced structure combines the stability of the core with the dynamic growth of carefully chosen stocks. Think of your satellite stocks as your dream team. They each play a role to help you win the championship of wealth building. Section 6, adding $1,000 per month to your portfolio. Now, what if you're growing your portfolio with $1,000 every month? Here's a simple plan. Allocate proportionally. Add $800 to the core funds to maintain stability and $200 to the satellites for strategic growth. Rebalance regularly. That means that every 6 to 12 months, check your allocations and adjust as needed. Seize opportunities. If you see a great entry point for a satellite stock, allocate more there. Just keep it balanced. Think of this process like watering a garden. Most of your water goes to the big, sturdy trees, which are your core funds, but you still need to nourish the smaller, vibrant flowers, which are the satellites, that make your garden truly beautiful. Section 7, managing your portfolio. Remember, managing your portfolio is an ongoing process. Here are my top tips. Rebalance regularly. Stay aligned with your goals. I suggest rebalancing once a year. Monitor your performance. Keep an eye on your satellites and don't hesitate to make changes. And stay disciplined. Stick to your strategy and avoid emotional decisions. Think of rebalancing like tuning a musical instrument. When things are perfectly in sync, the result is harmony in your financial journey. And there you have it, the core satellite portfolio. This strategy blends the best of both worlds to help you achieve consistent growth and financial independence. If you found value in this video, share it with a friend. Also, I'd love to hear from you. What is your satellite portfolio? Drop your ideas in the comments below. And if you haven't done so, be sure to check out the Always Be Compounding online community. It's a place where investors like you come together to learn, share insights, and grow their financial knowledge. Join today via the link in the description. Remember, the key to building wealth is to, you got it, always be compounding. See you in the next video. Take care.